The discussion about price action trading and whatever is better to trading with indicators is as old as trading itself. There is often a huge argument underway between the traders who think price action trading is best way of trading their markets and the trades who think using technical indicators is the best way to trade. Price actions trades always says price actions is better because it doesn't lag behind the market actions. Whatever the indicators trade states that trading with indicators is simple and trading with price action because you only have to lean what the indicators is showing you in order to use it. So today I wanted to settle this argument once and for all by breaking down the difference and similarities between the two methods and by the debugging the most common myths about these two trading approaches. The first myth is the price action is better than indicators. Price actions trades claim that it's a much better trading method in general. I'm not saying this affirmation is false, but if you dig a little deeper, price action and indicators are not that different. Candles or bars charts are tools visualize price informations on your chart. Indicators take the same price informations and apply a formula to it. Indicators don't add or take away anything from the price informations you see in your candlesticks. They just produce the informations in a different way, and I will explain this later in the video. The second argument is that indicators are lagging while price actions is leading. A trader who claims that indicators are lagging hasn't understood their true meaning. Indicators take parts price actions and then visualize the result after applying a formula to it. Those what your indicator shows you is the result of the past price actions. However, a trade who analyzes the pure price patterns does the same thing. If you are looking of the head of the shoulders or the triangle pattern, for example, you are also looking at past price actions and price has already moved away from the potential entry point. You see both methods are past price informations and are those lagging if you want to call it that. To overcome the lagging complement, you would have to set your indicators in the shorter time setting or only use a few past candles to make your analysis. However, the analysis becomes less and less significant the further information is good. Another argument that the price actions is simpler and better for beginner in trading is that rarely true that one thing is better than the other, and it usually comes down to how to use your trading tools. Both trading approach work very well if you understand when and how to use them, but neither will help you if you don't know what to do with them. Without experience or proper guidelines, it's very easy to feel lost as beginner price actions trader. Trading candlesticks is not as easy as it sounds, and lots of the components often get overwhelmed, such as the size of the candlesticks, how they comparative to previous price actions, and complement of the monument and volatility in wicks and bodies. Don't make the mistakes of choosing the price action because it looks simple, and trade who doesn't understand the nature of the price actions trading can easily read charts with the wrong way. The same is true when the trading with the indicators. Another argument is that the price actions trading is better because indicators are massive. This is the particularly true. Of course, if you are applying 6 or 7 oscillators and 10 moving average to the chart, you can quickly code up your screen, but that's not how indicators trading works. When it comes to indicator trading, professional traders usually pick one oscillator to analyze the market movement and another indicator to demographic the trend. A good combination of the stochastic with which is a monument-based oscillator, and the moving average indicators can provide guidelines and help traders to objective trading decisions. There is the little room for the subjective where it comes to analyzing an indicator. On the other hand, price action trades who look at blank charts can easily feel lost, lacking the clear preference point or tools to help them to make the trading decisions, resulting either acting emotionally or impulsively. It's also positive for price action traders to create too much noise to their charts by using too many support, resistance lines, trend lines, and candlesticks components. So while some traders feel more comfortable using indicators to take away from the subjective, others prefer to price actions analysis. Another myth that is professionals don't use indicators. Again, it's very hard to validate such a claim, and it's all comes down to the personal preferences. A professional trader chooses his trading tools wisely and understand the pros and cons of the different approach. There is the better or worse when it comes to the price actions as indicator trainings. It all comes down to how to trade, utilize his trading tools to make trading decisions. Now that we decided our argument in the favor against both trading systems, let me explain how I personally approach the markets. Considering how different prices actions trading is comparative to the training with the indicators, it's amazing how many simulators they actually share with one another. Both price action traders and indicators traders will make all of their trading decisions using the price chart, and they will both determine which direction the market is likely to move using just the market price. The big difference between the two is the way they both analyze the price to make predictions about the future. All indicators are determined from past markets, which essentially means the indicators trades are trying to predict the future using only the past. Price actions trades to this, but with one very important difference, they are trying to predict the future by combining what happened in the past with what's happening in the present. That's why I tend to make my trading decision based on the price actions in the first place. For example, a typical price actions trading strategy will be one of the most hardest effect. For example, my typical price action trading strategy will be one where the price action trades will determine a level with the market of the formulas based on the past price history, and then watch the price to see what happens when the market returns to the old level. If the market comes back to the level and they produce the price actions pattern, the trader has knowledge of the could see this as the beginning of the signal the market wants to reserve and move away from the level, in which case he may enter the trades. In this example, a price actions trade has used the past of the conjunction with the present of the formula the basis to the where market might be happening in the near future. He knew the market had reserved a level in the past, but he doesn't know if it is going to reserve at it in future. So instead of just jumping to the trade beating the level is going to the cost of the reserve, he waited until the market refused to the level and analyzed if they're resolving price actions. Confirmed that the level had a high chance of the causing result. This is how most price actions trade analyze the market. They try to either use the past combined with the present to make their trading decisions, or they just base their decisions simply by the analyzing what's happening in the present. That's why I think price actions trading has an advantage over trading with the indicators. Now, the main difference with indicators traders is that make all their decisions on things which happened in the past. They don't combine the past with the present like price actions traders do. They just use the past. This is because all trading indicators are calculated from the past price actions, so they don't show the traders information based on what's happening right now. They show them information based on what happens in the past. So the truth is that the trades to make all their decisions using the indicators will always be late in reacting to the changes in the market, no matter which indicator they use or what strategy they use. For this reason, my preference is to determine what price action is going before consulting an indicator for the entry signal. Once I determine out the trend and find the key levels of the market, then I can consult an indicator for the entry signal in the directions of the trends. I am not pure price actions trader. I prefer to add indicators to confirm my bias. In this age of algo training and expert visions, indicators cannot be completely removed from the coalition. The most common issue is that they are lagging, but can be taken care if you know how to combine price actions with the indicator. I prefer to add the indicator in my trading setup because indicators are often clear signals. Indicators also provide reference points to the plane charts. Many traders argue that they feel lost by looking on blank charts. Decision making becomes harder with no reference point to guide them. Indicators can save a lot of time since focus the specific point of the chart. In the end, it is all about the preference of each trader. Some traders prefer the pure price actions, some ignoring of the completely and use indicators, and the consistent with their gains, and some are using a mix both methods. You just have to use both tools visually and then figure out which one helps you if you are making better trading decisions. As always, if you learn something new from the found value, leave the like to show your support, subscribe to our channel, and click the bell icon to stay in touch when we release a new video. Until next time.